Hey everyone, in today's video, we are going to be talking about earnings trading and the strategy we've developed at Predicting Alpha that helps our members go out there and make unbelievable returns year over year trading earnings. Most of the time, retail traders stay away from earnings events because there's a chance for so much volatility to happen around the stock. But what's important for us to think about as traders is that everybody else is perceiving that volatility too, which means the options are pricing in big moves for companies around earnings events. What our strategy does is identify the companies where the implied move that's baked into the options is bigger than what's actually likely to happen. And by identifying these companies and selling options across the board on all the ones that meet our criteria, we are able to do extremely well for ourselves. This video is going to go start to finish on running this strategy. We will start with how to use the terminal to find the trades we will take. And then we will talk about the execution of this strategy in terms of putting on trades, taking profits, and cutting losses. If you want to learn more about the core strategy beyond this video, I've linked a couple lessons in the description below, as well as an interview with our top earnings trader that should set you up for success. So let's hop right into the lesson and learn how to find an edge trading earnings events. Now, earnings is something you trade every day during the earnings season. And the first thing we need to do is pull up a list of events that are happening either after market today or before market tomorrow, so we can see which ones are actively available to be traded. To do this, all I need to do is use the drop-down menu on the scanner here and select today's earnings. Now that we are looking at just the events we can trade today at the close, we need to start applying some filters to find only the best trades. So what I'm going to do is look only at stocks that are above $15 in price, which we can see for today, they're all above at least $19 right now. So we're good there. Then I'm going to go over to average option volume, and I only want to see stocks that have, let's say, at least 3,000 daily average option volume, right? 3,000 contracts traded daily. So I type in 3,000 ... because that's the syntax we need to follow here. Hit enter. Now we've made that adjustment. And just by the way, if you aren't familiar with how to use the scanner, there is a particular way to type in values, so you can watch a video also linked in the description to learn how to use it properly. Now from this point, we've applied our liquidity filters. We're only looking at earnings that are happening today. And now we have many different factors we can use to sort and further filter events. I personally like to keep things simple and sort the remaining stocks by their implied move for this event versus the average amount we actually see the stock move on earnings. This is because the ones with the biggest spread between implied and realized earnings moves typically have the biggest premiums for us to capture, just like with other option strategies. But as you start implementing this strategy, you'll find your own stride and add more filters and sorts. So what we're going to do is we'll come over here to the implied earnings move, which is IEM, divided by the average move, which is how much it actually moves on average. And by clicking the header here, we can change the sort from lowest to highest to lowest. And we're going to look at the ones that are going from highest to lowest. And we can see, for example, TD is at the top of this list. Once we have our list, now we need to evaluate each ticker to see which ones we should be trading today. To do this, there are 4 key things I will look at: the key metrics box, the historical moves analysis, the strategy backtest, and the seasonal moves plot. So let's do an example together. The ticker we are going to analyze together is FIV, which is found here. It's just on the first page of the scan that we ran for today. So I'm going to click on that, and the terminal is going to populate this page with data for this ticker. First thing we're going to look at is the key metrics, which is found just to the right of the earnings scanner right here. This is going to give me a quick overview of the stock. We can see that the implied earnings move is much higher than the absolute realized move that we typically see for the stock. And looking at the highest realized move, we can see that it's less than 2 times the implied earnings move that we're seeing right now, which makes me feel pretty good about the trade so far, since I'll be using this number to stress my position to figure out what my max loss potentially could be if I were to place this trade. I can also see that the straddle performance is very negative, which is a great sign for selling options. Because when straddles are losing money, that means we are making money by selling them. So far, this trade is looking pretty good. Next up, I take a look at the historical analysis here. The main reason I do this is because I want to compare the implied move with the realized jump. So we're going to take off the realized move here and just look at the realized jump. The jump is what happens to the stock right in the morning. And since we are going to be closing out the trade right in the morning, I want to see how big the gap between the implied move and the jump is on average. Looking at this stock, we can see that the jump is almost always less than the implied move, meaning the stock has not moved as much as implied right in the morning, which is another great signal for us to place this trade. Up next, we're going to take a quick peek at the strategy backtest here, which shows us how we would have performed buying straddles, or over here we can change it to buying calls or buying puts. For this purpose though, we're going to look at buying straddles. This basically shows us the P&L for each trade over the last 4 years if we were to be buying these straddles around the event. And since we're going to be selling, we ideally want to see a nice trending line down and to the right. If we see the occasional big up move in price though, that is to be expected. For example, what we're seeing here. And this is because we need to remember that we are basically selling insurance around these earnings events. So we need to be prepared to take a loss once in a while on any individual trade. If I see a line though that is very positive or very choppy, then that would deter me from taking the trade, especially if there are many others for me to choose from. But as we can see here, we do have this nice line down and to the right. The P&L is down over 200%, meaning we would have made over 200% being the option seller over the last 4 years here. And this is a really good signal for me that this is one of the trades I should be adding to my earnings strategy today. Lastly, we are going to take a look at the seasonal earnings move graph. This graph takes all the earnings moves from the last 4 years and shows us them grouped by quarter. This is by annual quarter, by the way. So for example, the first box is from January to March. This is the earnings from April to June, then July to September, and then October to December. Since it's November right now, we are going to be looking at this fourth box here. And what I want to see is that the moves in this quarter aren't skewed against me, meaning that there are more surprises in this quarter than others. But looking at this, everything seems to be in line. In fact, the highest move we see in this quarter historically is lower than the current implied move, which is another great signal for me. Now that we have gone through this analysis, I feel confident that this is a trade that I would want to place. So what we can do now is talk about execution of the trade. So here we are on the option chain for FIV. And since we are trading the earnings event, we need to remember that we don't have a view on much else, right? We're not thinking about how it's moving on a regular day to day. We're just looking at the earnings event. So we really want to work to isolate the event as much as possible. So we really want to work our trade to make sure that we are isolating the earnings event as much as possible. The best way to do this is to put the trade on close to market close and then exit the trade in the morning after the implied volatility drops on our trade. This minimizes our exposure to regular day-to-day volatility and maximizes our exposure to the event. A second way that we can really work to isolate the earnings event is by trading an option expiration that is really near dated, something that doesn't have too much exposure to time. For example, if I was trading the earnings event, I wouldn't want to be trading the May 2023 options here, which are 170 days to expiration. Rather, I'd be looking at trading either the weekly options expiring this week or next week, or if there's no weekly available, I would trade the closest monthly expiration. For this case, let's say we're going to trade the December 9th expiration here. Now, when it comes to what structure we are going to use, the optimal one is an at-the-money short straddle. If there is liquidity and they are available, remember, the weekly options are a good way to go. Now, if you are new to earnings, traders will often try and trade an iron fly or an iron condor. If you are going to do this, make sure to put your wings at least 2 times the price of the straddle away from the strike you sold the straddle at. Otherwise, the cost of the wings will eat up too much of your edge. As you can see, on most of the earnings events that we've traded, we make a nice little premium, and by getting the wings, we are really eating into that. If you want to reduce your risk exposure, my recommendation is to either size down the trade and trade less straddles, or to find a stock with a lower share price so that the cost of the straddles is less. Now, if you want to see what our trade will look like in the morning, we can analyze our position. So let's go ahead and put one on here. Let's do the 155 strike. We're going to sell a straddle. Let's analyze this trade. And we'll go down to just one lot so everyone can see it. Right, looking at one straddle here. So what we will need to do to see what our position could look like in the morning is we need to do two things. Number one, we need to move the days forward by 1. And then we need to adjust the implied volatility by how much we think the IV will decrease by. So let's go ahead and do that now. First, we're going to come over here to the date, move it forward 1. There we go. Then we're going to come back over to our terminal, and we're going to take a look at the expected IV crush number here from our key metrics. And we can see that it's 31.8. So what we'll do is we'll come here back to our brokerage, go over to this IV adjuster, and we will do minus 31.8. And we will do that for both of the options here. Minus 31.8. So the purple line here is what our trade should look like in the morning. And we can see that, if we see like a 10% move in either direction, we're kind of at our break evens. To the upside, we'll lose a little bit more. And if we see no move, we would make $600 per straddle. You would also be able to do things like stress your position here to see what happens under different circumstances. Let's say we want to look at what the biggest move we've seen was 4-5 in the past. We would see that it's 13%. We may want to ask ourselves, well, what's our risk if we see a move like that again? We can use our price slices here to put in the 13%. So if we see that 13% move, we're risking about $500 to the downside and $700 to the upside, which is actually pretty good given that our potential payoff is so high on this trade at $600. Now, the last thing that we need to talk about is exiting our trade. And this is a very, very important part, so please listen up. If you close your trade out right at market open, there is a good chance that the implied move of the event will still be being priced in, meaning this IV won't have adjusted yet. Right? It'll look something like this. This is because the market takes a second to adjust after a stock has a big move. So make sure you wait for the volatility to drop, because this is where a lot of your profits will come from. There is only one situation where you do not wait, and that is if there is an absolute blowout. Let's say the stock is implying 7% and it ends up moving 15%. At this point, we do not want to wait to close. And this is because the IV drop won't actually help us much, and the real risk to us is that the stock keeps moving a lot. Right? If we look at this 13% move here, there's not much room for our P&L to really go up, right? The blue line is the max it can get to. So for the sake of $50, do we really want to hold the stock and risk that it continues to travel down? Probably not. And these situations will happen occasionally, so we need to keep this in mind. One last tip for you is to try and get the best fill possible when entering the trade. Remember that every dollar you collect means you are actually selling a bigger implied move, meaning your break evens are wider and you might make more money on each individual trade. If you rush in and just sell it for whatever price, you might be selling a smaller implied move than what we used in our analysis, which can really hurt your edge and your trading business. There are many variations to this strategy that members at Predicting Alpha trade, which I'm sure you will become familiar with over time. There is an entire channel in the Discord dedicated to this strategy, so make sure you join the community and connect with the other members who are trading this strategy. And if you want more education on this strategy, you will find videos towards the end of the bronze education that talk about it in depth. And with that being said, happy trading, and I'll see you in the next video.